Hi guys, welcome to my channel. It's Roxy Whitney here, your favorite Rocket City realtor, and in today's video we're going to be going over some first-time homebuyer tax write-offs. So without further ado, let's jump on into the video. Okay guys, so just getting started, we're gonna want to talk about the difference between your standardized deductions and your itemized deductions and why they really matter. So your standardized deductions are your congratulations deductions the government gives you when you qualify to pay taxes. It's like their little reward or golden star. So your standardized deduction as for 2021 was about $12,550 if you were filing single, and if you were filing married jointly, it would be around $25,510, which is an odd number, but is what it is. And in 2022, it's single, you're going to be $12,950. In marriage, you're going to be $25,900. So these are just your standardized deductions. And why it matters again is because that's your congrats from the government for you to be paying taxes. But if you are not spending that much to be able to write off of that much money, like if you're not reaching that max threshold there, then you're not able to use the itemized deductions because you haven't even used all your free deductions. So once you're done using all the free deductions, then you get to have fun with the itemized deductions. So now that you know that and have kind of an idea of if you are in that zone or not, now we'll jump into itemized deductions. So where do you find itemized deductions? You're gonna find those on an IRS Schedule A form. That's just what it's called, and that has your itemized deductions on it. Now, if you have a CPA, they will do all of this information for you. I am also not a CPA. I am a local real estate agent in Huntsville, Alabama, and I'm also licensed in Florida. So take all of my information with that in mind. Always ask a CPA. Moving forward from that disclaimer, your first thing you're going to run into is your SALT deduction. Just kidding. It's the acronym. It's your state and local tax. So your state and local tax is going to be your state and local taxes. And this is where your property ownership is going to come into play, because now you, fine gentleman and ma'am, are paying property taxes. So now that you're paying property taxes, you can write that off. Of course, you have to complete those standardized ones first. But now that you can write that off, I know you're like, woo, so excited, yay. Also, check out my video on how to figure out your property taxes in Huntsville, Alabama, in the little link above. So moving forward. So once you have your property taxes and you're like, yes, woohoo, I can write this off. Just a small little disclaimer, you know, if you live in a McMansion, at least here in Alabama, because we have very low property taxes, and you pay more than $10,000, that is your cap for this category. So that also includes state taxes. So you have to factor that in with your property taxes. But it cannot go over $10,000 as you are capped off at that amount. So keep that in mind. Moving forward to the next one. If you have a mortgage on your house, which as a first-time home buyer, I assume you will have a mortgage on your house, you can deduct your mortgage interest. Yay! At least you get to deduct it to something. Also, little side note kind of thing, it does have a cap on it, and it was made in 2018, and you cannot deduct more than $750,000 worth of interest. I know. Probably a lot higher than you were thinking. Again, unless you're buying a McMansion, probably doesn't apply to you. So no worries there. Moving on. Also, if you're not making the money of like high-enders, okay? If you're not like up to that level yet, and you're filing married and you're making under $100,000, or if you're filing single and you're making $50,000 and under, keep this in mind too, because you qualify for another deduction. And that, my friends, is your mortgage insurance, or your like PMI that you would be paying on your mortgage. And if you put more than 20% down on a home, you probably do not have mortgage insurance, as that's normally what once you put that amount down, you don't have to have mortgage insurance. So also keep that in mind, because if you did put 20% down, probably you're not even paying it anyways. But if you are paying it and you make under those amounts, make sure you ask your CPA if you can deduct those, because that could help you out. So that's pretty much all of your write-offs as for that side of things, and make sure that you complete your standardized deductions first to be able to go in and dip your hands into the itemized deductions. There are some other itemized deductions you can play around with, but these ones are really the ones centered on buying a house. So those are the ones that you can kind of use with buying a property. And they definitely can save you a ton of money in taxes. Like I said, the exemptions, $10,000 for your property taxes and $750,000 for your mortgage interest. So just keep that all in mind. And now moving into a little side note to just keep in the back of your head. Whenever you sell your property, you are going to have immense capital gains. And especially here in Huntsville, Alabama, where the housing market is appreciating over 20% every single year, yeah, you're gonna have some capital gains whether you renovate that property or not. Also, side note, renovations are not tax write-offs for a primary residence. That kitchen that you just installed, that was all on you, honey. So moving on. Now, when you sell your home, you're gonna have tax-free up to $250,000 of the capital gains. So that is the money you have left over that's just gain. And that's single. If you're filing married joint, your capital gains can be $500,000 or more, okay? Again, this is more of a McMansion incident where you might run into issues. Other than that, you should be good to go there. Only caveat with this one is you do have to have lived in the home for 2 out of the past 5 years. After that, you are clear to go, my friend, and you can happily put all of that back in your own pocket, and the government can't take any from you. So moving forward a little bit more, I'd like to talk to you guys about this new thing that is also expiring. So if you are planning to do any energy remodels, please do it before December 31st, 2023. If you're planning on putting on solar panels or getting any of that fancy energy green equipment in your house, you can deduct 22 to 33% of the cost of installing whatever that is. So if you're already planning on doing it, make sure you ask your CPA about the tax write-off. You just have to do it before that cutoff line of December 31st, 2023. Also, I would like to note, do not install these things unless you already want to. Do not do it for the tax benefit, as it is not an easy process, as your CPA can let you know. And also, you don't even get 50% back. So it's really more of a benefit for going green because you want to, rather than a push to go green. So take all of that in mind. So now that you guys know some property tax benefits of buying a house, and yes, they are amazing, make sure that you guys really take advantage of it and ask your CPA about everything possible. And have fun and enjoy your savings. And I wish you the best finding your next home. And if you're already there, I wish you the best on your housing journey. And if you liked this video, make sure you give it a thumbs up and you hit the subscribe button below. And have a great day, guys. Bye.